Thanks for tuning in to this broadcast of The Resilient Advisor. My name is Jay Coulter, and joining me for this episode is Chris Versace, the CIO of Tematica Research. Before we get started, Chris, this is something new for me, but we are now running ads on The Resilient Advisor. I want to let the advisor community know about a new service that we're offering at The Resilient Advisor. It's offered through Lead Pilot. And Lead Pilot is an incredible communications tool to help you manage your email communication and social media management. They make it incredibly easy. I have seen this platform have incredible results for financial advisors. If you're interested in learning more about how the Lead Pilot system can help financial advisors, please visit jcoulter.com/lead pilot. That is jcoulter.com/lead pilot. Chris, you and I have been doing broadcasts together now for over a year. That's the first ad you've ever had to sit through.
You know, it is the first ad. And I remember my days back when I was a sell-side equity research analyst that, you know, it wasn't so much social media because it didn't really exist back then, but it was more on instant messaging and keeping track of it from a compliance perspective. So I've got to think, Jay, that even though you're springing this thing on me, that it's got to have some tie into a compliance solution that probably advisors could use, and it would be helpful.
Yeah, technology today is amazing, and they can integrate all this stuff not only into a compliance tool, but inside of CRM, and it just makes things for advisors a lot easier to manage from a marketing front. You haven't been on in, gosh, I think about a month and a half now. Let's catch up with you. First, let's start with, what have you been doing?
What have I been doing? I've been doing what everybody else has been doing. You know, kind of Groundhog Day, you know, same day, same thing almost for the most part, trying to break out a little bit, you know, more takeout. I ventured out a little bit, eaten out a handful of times, very different experience. It's no longer the leisurely dining experience. It's kind of like, here we go, here we go, here we go, out. You know, it is what it is. You know, so just kind of that, you know, trying to, probably not drink as much as earlier on in the pandemic and probably trying to exercise a little more. But we also got some interesting and cool things that we're working on at Thematica, including a couple new indices that'll be hitting soon. We've also got in Europe our second and third supported ETF products hitting either later this month or in September. And then we've got, you know, a couple other skunk work things that I know you know about that we really haven't talked too much about.
Yes, and in a few minutes, I'm going to show viewers the Tematica Leaders portfolio, which you and Lenore do not know. I've been stalking and incubating on my Y Charts account. The performance looks great, and we want to talk a little bit about it. But
Sure.
Let's start macro.
Sure.
A lot has happened in the markets over the past month and a half that have real applications for financial advisors building portfolios. Give us your thoughts on what you've seen the last month and a half.
Well, I mean, look, I think a lot of people have enjoyed the grind higher, you know, kind of in the market. I think what you have to realize is there's really a handful or a little more than a handful of stocks that are driving it. Everything from, you know, Apple, Microsoft, Facebook, Google, and Tesla. They just seem to be rising, you know, perpetually. I think Apple last week, you know, notched another 8% gain, you know, and the perception is that the overall market is moving higher, you know, and when I say the market, we're talking about the S&P 500, which of course it is. But when you dig into the internals of the 500 constituents, you see a very, very different story. I think, you know, case in point, last Friday, 500 stocks in the S&P 500, 200 moved higher, 300 moved lower. But because of the weightings and the certain constituents, like the ones I mentioned, the high five, as they're called, the market continues to grind higher. So it's a little disconcerting. You know, if you stop and think about the overall market, S&P 500, about EPS growth, you know, 2020, we know it's going to be down. But to me, I've kind of adopted a little bit of a different framework that's comparing 2021 to 2019. And, you know, when you start to look at it on that basis, you know, we're probably going to get 1-2% EPS growth, something like that.
So you're just going to skip a year.
Well, you know, believe me, if there was a way that I could get a shot and it would knock me out for the next, 4 or 5 months, I could wake up in January a happy man. I would pay almost anything for that, considering what lies ahead. And you know what I mean, in about 70 days and all the nonsense we're going to hear between now and then. So, as well as the virus and other things. So what I'm trying to do is really understand if we do our best to account for the economic toll of the virus and the earnings toll of the virus, what might a more normalized year look like? So trying to use 2021, the jury's still out, candidly, as to whether that's going to be a normal year. I don't think it will be. Certainly not, the first quarter, maybe not the first half of the year. Personally, I think a lot of it hinges on when we actually get a virus in mass into the hands or into the arms or legs or whatever it might be to a lot of people.
Virus? You want us to get a virus into the hands of a lot of people?
Oh, I'm sorry. Vaccine.
Yeah.
I was like, Jay, it's like that scene in Animal House. Bluto's on a roll. Don't interrupt.
Dude, there's
But yes, the vaccine. But yes, the vaccine.
Viewers, Chris is great at referencing 70s and 80s movies in the middle of a broadcast. Let's go back for a second.
Mm-hmm.
I believe someday people are going to make a ridiculous amount of money, and this is not investment advice, shorting the stock that you were just talking about. But boy, people have lost their shirt with Tesla.
It's
short side. How do you justify where Tesla sits today?
So there's two or three ways to talk about that. So let's talk about it from the way most would, which is from an earnings perspective. And I don't think you can, right? It is a story stock, a cult stock. And from a thematic perspective, or let's go story perspective first, right? They seem to be executing on all the right levels, right? They're shipping more cars than expected. They're getting greater traction in markets outside the US. They're going to have more models. The price points are coming down. These were all the things that people expected from the story side. I still have fundamental concerns when, the large auto OEMs finally get around to delivering their not 1, 2 models, but as they really transition a greater number of their offerings to electric vehicles. As that happens, the competitive landscape will be something that Tesla has never faced before, right?
Mm-hmm.
So now let me come to it from a thematic perspective. Look, Tesla sits inside our clean living investment theme. We know that people are continuing to adopt better for them, better in their bodies, on their bodies, in the environment solutions. So at least for the near term, Tesla has a rising tide perspective, if you will. And a while back on another podcast, someone asked me the question, well, how do you justify some of the PEs with some of these thematic companies out there? And I said, well, the first question is the theme still playing out? And when you look at overall adoption of electric vehicles, whether it's in the US or in other markets, it's still rather small. And I think there's more room to run. Having said that, again, shorter term perspective, long term, you've got to be aware of the significant pivot that's going to happen in the competitive landscape. The issue that you pointed up, Jay, is people have been betting against Tesla, but Detroit and others like Honda, Toyota and the like haven't really brought those electric vehicles to market as fast as people had hoped that they would.
Mm-hmm.
So I'm sorry. What was your question again?
At some point, I think Tesla's going to present the short of a lifetime, just for the simple fact. And while that's not investment advice, there's no way to justify the valuations that it has today. And here's the thing. There's a great way to tick off my audience. Number one, suggests that Warren Buffett doesn't know what he's talking about. Another way is to suggest that index fund investing isn't the best idea for everybody. And the third is to suggest that hedge funds are a bad investment. I've also learned if you criticize Tesla investors or Bitcoin investors, you get the same type of noise. I just have a hard time justifying some of this.
Well, I'm fascinated by your market research about the Resilient Advisor. We'll have to talk more about that, offline. But here's the issue: story stocks work until they don't. And in my career that dates back into the early '90s, there was no shortage of story stocks. Whether it was Cree with the LED boom, for example. Whether it was, Netscape. You remember when Netscape went public and ultimately it flamed out, MCI, WorldCom and all. And there's no shortage of them. And I think people need to recognize a story stock when they see it. People, it's, I'm going to bungle this, but it's like they love to hate them and hate to love them. But when they are a fan favorite, that momentum can be a very powerful thing. The other thing you have to think about too, though, is past a certain point when companies become EPS positive, right? That really changes the way people start looking at the stock price and the valuation. When a company's not making money, You remember this large company, perhaps you heard of them, maybe you use them. Oh, Amazon. When they weren't making money, it was an unbelievable stock, right? But once they started flirting with positive EPS, there were all sorts of questions as to what could Amazon really deliver in terms of earnings power. Now they have gone on, and they're crushing it in terms of EPS generation. I think we'll see that when we get to your thematic leaders chart that I know you have tucked away. But when companies start to turn positive, all of a sudden the PEs look expanded, right? All of a sudden the PE to growth rates look expanded. And that's when there tends to be another hard look at these valuations. So, do I know that it's going to happen to Tesla in, 2020, 2021? I do not, but I can tell you it's probably far sooner than it's ever been before.
America Online.
Yep, there you go.
America.
You are connected. You have mail.
Man. All right. So at the beginning of the year, you shared with me the thematic leaders you had for 2020 in the portfolio from Tematica Research. I took them, I threw them into my Y Charts account. And Chris, I've just been tracking them. We haven't spoken about this yet on the show, but I think now's a really good time because we've seen an incredibly challenging period as it relates to obviously the economy, but for financial advisors building portfolios. And what I've learned through my relationship with you is the difference between thematic investing versus sector investing and how powerful it can be. We're not supposed to talk performance, but I'm talking performance here.
I'll let you handle it.
You can see the dramatic performance year to date of this portfolio up 46% versus the overall S&P 500 up 6%. The attribution driven to this performance is squarely on the thematic concept. Chris, for folks new to this, walk us just very briefly, high level, what thematic investing is, and then let's talk about some of the key themes that you see playing out and working right now.
Sure. I'm going to preface that comment, Jay, by saying we've known each other for quite a while now, and you know that I am never brief. Having said that, for us at Thematica, the heart of thematics is really identifying structural changes that arise because of changes in economics, demographics, technology, psychographics, and some other regulatory mandates and things like that. And once you identify these pronounced tailwinds, more oftentimes reflecting a change in either business behavior, consumer behavior, they present powerful opportunities for well-positioned companies. The trick is to identify what those themes are. And, I've been doing this, a long time, really since I saw the shortcomings with sector investing, or as I refer to it as a vertical view from my time as an equity analyst at FBR and other shops. And the key here, if we think about it, is if we can identify the right themes, this powerful tailwind will push revenue on the right companies, push earnings growth on the right companies, and earnings growth tends to be the driver of multiple expansion. So that's kind of a roundabout way, Jay, of saying if you do thematics correctly, you should identify drivers of alpha. You with me?
Clearly you have in this portfolio this year.
Well, here's the key, right? So when, on another chart, and I'll actually give this to you so your subscribers and listeners of the podcast can see it. When you take a look at the expected earnings growth rate from 2019, 2020, 2021, for each of the 13 thematic leaders, it's almost up double digits for each one. And then there's one or two exceptions like Farfetch, FTCH, which I just mentioned. Let me mention now. They're a luxury play, but also an online play. So they actually have two thematic tailwinds, right? Digital lifestyle for us and living the life. And, they are simply killing it in part because of the pandemic, but also the natural shift towards digital shopping. And they're focused on luxury. So if you think of earlier in the pandemic, when folks out of Asia were not traveling, folks in Europe were not traveling, how were luxury shoppers going to get their goods? They flocked increasingly towards online, in particular Farfetch. And we look at their numbers either for gross merchandise value or number of account holders, subscribers, call it what you will. It is simply off the charts. And that's before we go into the retail heavy back into the year with the year-end holidays. Now, the reason I point them out is given the comment I made earlier about Tesla, they are not EPS positive. But when you but here's the thing.
You think?
They are chewing away. So bottom line losses continue to contract year over year, and the company thinks it's going to be EBITDA positive in 2021. So we're close. But each of these is a powerful embodiment of their respective investment theme. Hence the term thematic leaders.
All right, so let me go back to the Y Charts account here and show you something. And I'd love for your comments on this. So this is a breakdown by sector exposure of the thematic leaders portfolio as it sits today, not as it sat at the beginning of the year. We're looking at 33% consumer cyclical. We're looking at a pretty heavy allocation to sensitive stocks in the communication technology space and technology space. But you also balance it with a little bit of defensive if that's the lens as a financial advisor you're using when adding models to your portfolios for your clients. Talk to us about your thoughts on the sector exposure right now.
I got to be very blunt with you. I don't.
Tell us why.
I just think sector invest, we're going to have T-shirts printed up that say sector investing is dead. And the reason is very simple. There are thousands of stocks, right? You can talk, Russell 2000, you can S&P 1500, or even the Wilshire, which I don't think is quite at 3,000 stocks anymore, technically speaking. How in God's name do we classify all of these stocks into, 11 sectors there? It's not a real reflection of their business models. I would argue more often than not, it is square peg, round hole. And it also doesn't account for business transformation. Okay. So, take, we could do Apple, but let's do Netflix. A little different. When Netflix first started out, right, what was it? Mail order DVDs. Today, that business really doesn't exist anymore, and it is a streaming giant. So what bucket would you put them in?
Okay. So I understand exactly what you're saying. I buy into that philosophy. A financial advisor watching this show, if there was, and you don't currently have a US-based ETF to execute on this strategy, but you are going to be offering this portfolio in the forms of model portfolios on a subscription basis to advisors. Advisors are going to struggle because all the tools they have on their desktop look at sector exposure. When they build a portfolio for clients, they have to account for sector exposure in the investment policy statement. So how are we going to encourage advisors to rectify that as it relates to building their overall portfolio for their clients if they're using this type of model?
Well, I think we're going to do two things, Jay. I think we're going to show them the thematic representation, right, across our 10, 11 themes. And then side by side, we'll have a pie chart that kind of shows this as well. But here's the thing, right? If you're thinking about sectors, you will, particularly if you're buying sectors, and I'm obviously not a fan of buying sectors, you have to stop and contemplate what areas of the sectors are doing better, what areas of the sector are doing worse. Through thematics, we can actually identify that, if you want to think of it that way. I think it's a tough spot, to be honest with you, right? And I think if you look at, given my comments earlier about, on Friday, S&P 200, the S&P 500 up, 300 down, that is going to weigh on those sector descriptions that you have there. So it's a little bit of a conundrum. Have we thought it 100% through? No, to be honest.
Put you on the spot. Yeah.
Yeah, you did. Very few people do that. Congratulations. But I'll also backpedal a little bit and say, let's remember too that we haven't launched the models yet. So there are a couple things that we're working through, and I think you can tell by my lack of an answer that this is one of the things that we're working through. I do recognize that, even though thematic ETFs are growing, both here in the US and in Europe, as well as in certain Asia markets, that there are going to be certain advisors that have to kind of wrap their head around this different type of thinking, and there will be certain limitations on platforms that look to classify things in a certain way. That's not even counting, core or satellite or some other things. Again, I recognize that we're offering investors a different way of thinking about things. The positive thing, though, is at least your homework has shown that we're doing something right.
Math is math, brother. Math is math.
Yes, it is. Yes, it is.
All right. So what we'll do is this fall, we will produce a series on thematic investing and the implications for building models for clients and portfolios for clients. But most importantly, how to change an advisor's lens on looking at the market through that thematic lens and using the technology that they have at their desktop to facilitate that.
Did I just sign up for that?
You did. I just
Okay.
committed.
All right. Just that's fine.
Yeah. You don't come on for a month and a half and I start committing you to other things.
I know. There's so many changes, Jay. Your ads, all this other stuff. You're speaking for me now.
Brighter lights. I mean,
yeah. Well, you look. The positive is you look younger.
That's just not true. Before we started this broadcast, Chris goes, "Jay, is something wrong? You look worn out."
Well, it was because the lights were so bright, and you were I'm going to do my best here to.
I was like, "Oh, that's a good way to start a Monday. I got to fix a few things here."
Wow, nice to talk to you in 6 weeks. Yeah, thank you.
Chris, listen, I really appreciate you coming on the show again. I'm looking forward to producing that thematic series.
Sure.
Viewers and listeners, if you'd like more information about Chris and the Tematica Research team, please visit tematicaresearch.com. That's tematicaresearch.com. And you can follow Chris on Twitter. His Twitter handle is Chris J. Versace.
You clearly don't remember our conversation from about 4 weeks ago.
No, I do remember, but I saw that you've been posting.
That's not me. That's automated.
Chris let me know that he wasn't going to be active on Twitter anymore.
You want to hear a funny little story about this? Do we have time?
Let's do it.
Okay, so I removed Twitter from all of my devices, right? Because I wanted to fight the urge to, I'll just look here, and it's a slippery slope, right? In terms of all of a sudden you're back using it again. So I deleted it. And then I was like, I really should check it. And I can't get back on. So I set two-factor authentication, right?
Mm-hmm.
So so you have to authenticate on one level, and then you graduate to the second one. And on the second one, it says use your backup code or use a code generator inside the app. And I'm like, can't do it. So even if I want to get back on, I can't. And here's the funniest thing. I actually reached out to Twitter tech support, help support, customer support, whatever kind of support they call it. Have I heard back from anybody? Mm-mm. I don't think they want me back.
Chris, well, Twitter is a little worse off without you on there, my friend.
Yeah. So here, since we're going down this road, I have to be honest with you. I don't miss it. I also am glad that I'm not on it. So I left Facebook before the last election, right? And I got to be honest with you. I'm really glad I'm not on it with 70 days to go until the current presidential election, because it's going to be, I know I can't use certain language on this podcast, Jay, so I'm going to say this instead. It's going to be a poop show.
Yep. I don't disagree. Chris, I am glad you still come on the show, though. I really
always
appreciate it. We'll go produce a series this fall on thematic investing. Thanks again for coming on.
Let's do it.